Once more, good evening, everyone. I'm happy to be here in your face this moment. Another great opportunity and
Yes,
a
sir.
privilege.
Yes, sir.
Hello?
We can hear you, sir.
Okay, somebody, you need to mute yourself, please. We are all welcome to this tutorial today. It's actually Forex for beginners, and our aim is to develop a community of empowered people financially. And thank you, everybody. This class is actually Forex, not just for beginners. Don't be carried away by that beginners class we're seeing, because some of the things I'll be teaching here are things that after even 10, 15 years of being in Forex trading, I had to start learning all over again. In this industry, you don't plateau, you learn all the time. You can see our coordinator, the level of his age, he's still sitting down in a class here to learn. So it's not something that you say you have reached the top. But for the sake of those that are starting out, and that's why we call it beginners. And honestly, I won't bog us with a lot of theory. I took out days preparing this document we are seeing here. And I want to inform us that this academy, both the synthetic and this, has been sponsored by the Kanye Legacy, headed by our coordinator. And this will tell us in the long run, the vision and the goal. We're only seeing the baby. So without much ado, let me just go to the purpose of our class. If there's anything I will have to say, maybe at the end of the meeting, let's dive deep into why we are here. So really, what is Forex? Can you see my screen? I want to be sure you're seeing my screen.
Yes, sir. Yes, sir.
All right, okay. Now, what really then is Forex? I know the question some of us will be saying we've been hearing about Forex. Well, what I want to do here is, if you want lots of theory and complicated strategies, we're in the wrong place. You don't need another boring class, learning material. All we are intended here is for you to know that you will learn skill, and we'll try to simplify it. If you have been in my class, you understand that I try to simplify very difficult, bogus terminologies into as simple as possible. We just want to help you to become a better trader faster. So I'm following a faster route while simplifying terms, simplifying things. I'm only going to talk about things you will encounter as a trader and what matters, that even after my 15 years, up to these 15 years of trading, I'm still understanding it. I'm understanding why it was serious. When I started my trading career, I didn't take some of the things I'm going to teach you people today serious. It took me after like 6, 7 years, after a lot of losses, mistakes, and I understood that my mentors were right. Please mute yourself. Whoever is there, please mute yourself. We'll appreciate if you mute yourself. Thank you so much. So don't think this is another long theory, long story. Whatever I have to compress within this week, it's not ending this week, that's a continuity, but I have a responsibility for the next few days to ensure that you understand the basics and to the intermediate, if not even to the master level. So I'm trying to establish these facts that we'll be diving deep into what matters in this business. So what is the next thing? Forex glossary. What really is Forex? Forex is foreign exchange, bureau de change. Just another form of bureau de change. Buy dollar, you give naira, you collect dollar. Dollar goes up today, you exchange with naira. As of today, I think it's 1,550 something. We all know that it started from around 215 when we started Forex. When I knew whatever about foreign exchange, it was around 50 naira many, many years ago to $1, all the way to when I own. There was a time I owned a bureau de change. I had a license to operate a BDC, a bureau de change. And before I sold it, when Emifele came on board. And so I got into the business to the top of it, had a license to Central Bank of Nigeria, and then we go to collect dollar. You must have deposited the naira, and then you collect dollar equivalent. Then we go to the retail, and then sell it at an exchange and make 2 or 3 naira. So that is the exchange of foreign exchange. But now this has been digitalized and given a platform where you can trade, where the market is very volatile, has high liquidity. So you don't have to go through central bank. It has been decentralized. Everybody, anybody can trade. All you need is get trained just like this, have a phone, internet-enabled phone, and a laptop. You're good to go. Start trading, make deposit through a broker. There's a broker that interface who provides the liquidity between you and the banks. So you can trade, and there's always a remittance process through the process, through the exchange platforms. So the brokers knows how to do those remittance thereafter. So they too have to be licensed to operate. So you don't just work with any broker. So Forex is an international currency market. So I am putting effort on this leverage a lot. It has been the reason why people are losing. Even experienced traders are still losing massively in this business because of this leverage issue. So if we don't understand this leverage very well, it can just be your undoing. You don't just jump to a high leverage. And even if you're choosing a high leverage, choose a very small lot size. It's very important. It's very important. So what is the next thing to go to? We must understand the choice of leverage. This is how the leverage works. Leverage simply means borrowed funds, as I told us earlier. While the high degree of leverage used in forex trading magnifies returns and risks, a few safety precautions used by professional traders may help mitigate these risks. Now, because of the high leverage that these brokers usually give traders, that is why you have to understand the best strategy to apply. The best strategy to apply and the key place to enter. There's nothing wrong using a very high leverage, but you reduce your risk, calculate the risk you are taking by calculating the spread. The spread is what the broker charges for you to step into the market, and then the lot size. You understand what the lot size is. The lot size is the value of each pip in dollar. The value of each pip in dollar. This pip I spoke about. The value of each pip, and the value, you can choose the value. You can choose 0.0 cents. You can choose $0.1. You can choose 2 cents. You can choose, the broker allows you to choose the value of your pip. So if you are choosing to buy a very high leverage, make sure that you are trading on cents if you don't have big money. The pip you choose and the leverage you choose must align. The pip, you choose the value of each pip. The value of each pip is converted into dollar. You can say, okay, each pip for me on this trade is 0.01, is 1 cent, is 2 cents, is 5 cents, is 10 cents, which is $1, $2. Those things, they call it micro lot size and standard lot size. So there is mini, micro, and standard. The mini lot size are in cents. Then when we're going to talk about micro lot size, we are talking about $1, $2, $3, $4, $5. Then standard lot size. Standard lot size is what we're going to talk about per pip is equivalent to $10. So each pip move here is equivalent to $10. So when you move by 100, you will make $1,000. So for you to go and choose a lot size where each pip is equivalent to $10 and you are trading on the high leverage, the higher the leverage, the higher the opportunity or the chances of choosing a high lot size. If you don't choose a high leverage, the broker will not allow you to choose such a high lot size because your leverage is directly proportional to the size of your lot size, which is also directly proportional to the value of each pip. I am emphasizing, I can spend 1 hour talking about these two things. People are losing in Forex and other things because they don't understand this thing. Your money management is correlated to this pip, understanding pip and lot size, leverage and lots. Understand that if you're choosing 1 to 50, the broker does not allow you to choose a very big lot size, meaning that you are reducing your risk You don't have to choose a big lot size. It doesn't matter whether you're having $1 billion. You choose small lot size. You choose small leverage. So that even if you want to pick a very big lot size, the market will not allow you. So that's a form of discipline. If you're choosing a very high leverage, you're saying that even if I have $1, even if I have $100, I want to pick a lot size of 1 to 10. So that means that each pip is $10. That's crazy. There are people that do that. They gamble into the market. Either they win or they lose. You don't care. That's gambling. We don't teach that here. We teach this as a business, as a skill. All my students have been training for over 5 years. I teach them this business I teach them Forex as a business skill, not as a Ponzi scheme, not as a scam. Some people are still thinking that Forex is a scam, it's Ponzi scheme. No, it's a serious business. Without it, banks will not be in existence. We run it as a business. Now, this is an example of what I've been saying. You decide to buy 100 euro and sell dollar at the rate of 1,001 to 400. So what he's saying is that you need $0.41 to buy just you need $1 to buy equivalent of this euro. I don't want to confuse us on this. Just look at this example. You decide to buy 100,000 euro and sell USD at a rate of 1.4100. That's the exchange rate. Do you need more than 100,000 US dollars to open the trade? No. With a leverage of 1 to 50, you will need to put down only 1/5 of the deal size as the margin, which works out to this. What they're actually telling you is that for you to trade the equivalent of 100,000 euro, you need $2,820. This is the calculation based on the leverage you have. If you choose 1 to 50, you divide 100 times 50 equals to 2,000 euro. 2,000 euro times the exchange at that moment. This is this. Now, this is not what you do while we are trading. This is just to give you an example of the amount of money you need to trade this. But so don't bother yourself about for each trade. You don't have to go and sit and do calculation like this. This is mathematics. So any mathematics like this, I used to abscond in mathematics class. Now I am joining mathematics now in this Forex. So it's mathematics. No, it is not all about mathematics. You just need elementary mathematics. Some of us say we don't like mathematics, but if you're working in your office and your boss, instead of paying you 50,000 naira monthly salary, and he pays you 48,000, you begin to calculate. You know that there is a difference of $2,000, 2,000 naira out of it. That mathematics, you know. When you come to some mathematics on skill acquisition, you feel it's difficult. This is business. There's nothing big deal here. So all these things they're saying here is just to tell you how much you need to trade certain way. When we go into real practice, you understand what this means. In Forex, all transactions can be conducted via standard, mini, and macro lots. Each lot size accounts for each different unit. I've explained this to us. The lot size, there are micro, mini, and micro. So you see, you can choose 0.01, meaning that 1 pip equals to this amount of dollar, 10 cents or 1 cent, and whatever, 10 cents, let's say 10 cents. Each pip equals to 10 cents for micro lot size. Then for mini lot size, it's telling you that 1 pip equals to $1. So when you're choosing this or choosing this, you see what I was telling us? You cannot choose a big leverage with a small amount of money. That was why they are telling you here, if you want to trade big money, you want to trade with big lot size, then put in big money. If you want to trade big lot size with small money, then you have to increase your leverage. You can choose any amount of leverage. There's no limit to the leverage you can choose, as long as the broker allows you to choose it. So the brokers allow you to choose up to 1,000 or to 2,000 leverage, compared to this one that is talking about 1 to 150, 1 to 50. That means that for each $1, you can trade it 2,000 times units. So for the standard lot size, each pip is telling you that if you choose one, it's telling you that for each pip is $10. So if the pip is going in your favor and you have hello. Sorry everyone, I have to get another internet immediately. My internet is just strange this evening. So I'm back. Please, can you hear me all? Can you guys hear me?
Yes, we can.
Sir.
All right. So lot size and leverage are correlated. I have really spoken about that. Just know that the higher the lot size you pick, the higher your profit and the higher your loss if it goes against you. When we go into the practical class, you will now see how we apply this thing. And I'll be spending more time on this area, lot size and leverage. In fact, your leverage is not a problem to me. You can choose whether 1 million leverage. But this is where the cocoa is. This particular lot size, your choice of lot size, and your starting capital, your account balance, your equity. Your equity. The lower the equity, the smaller you should be thinking about micro lot size. Mini lot size. Those of us that are in synthetic will understand this thing very well. That when you're trading gain and pain, it is mini lot size that is available for gain and pain. This is the minimum lot size that is allowed in pain and gain. There is no micro lot size for pain and gain. Micro lot size is only available for the rest of synthetic indices like FS volume, Flip X, SFX, and Switch, and Trend, and the rest of them. They allow you to trade this micro lot size because of the high volatility that is there. So these two is only allowed for pain and gain synthetics. So I just wanted to clarify that. But in Forex, you are allowed on all the currencies to trade even as little as this. It's just that, well, you'll be making smaller money. But the same way, your loss will be lower. So for somebody that is going on this, you should be having nothing less than $200, $300, $1,000 for you to attempt to use this lot size to trade. It does not matter your leverage. But the leverage is very, very small. And then you are trying to trade standard lot size on an account of $100 and you choose a leverage of 1 to 50 or 1 to 10. The broker will not allow it to work. It won't even fly. So just know that for good money management, you look at the account size, that is what should determine the lot size you use. Because the lot size, you gauge it with your take profit and your stop loss. You understand what is stop loss and what is take profit as you progress. For those of us that are new into this. So I'm trying to move fast because the internet has really taken much of my time. So this is an example of what I've been trying to explain. You open a position of one lot size, which requires an initial deposit of what? This is how to know how much you need to deposit. If you want to trade on the lot size of 1 to 50, you need this amount of money to trade 1 pip to $10. If you want to do standard lot size, you need $2,760 if you want to choose this leverage. So you were right, euro depreciate against the dollar to this amount, maybe from 1.35 something, and you decide to close your trade and take your profit. Result, the euro fell by 692 pips. So you see the pips I'm talking about. So this 692 pips is talking about here is that for each pip is equivalent to $10. So you calculate $10 per, your profit is 69 times 1 lot times 50 leverage. This is what it means. That means that you are making 50 times whatever profit you are making. Your investment, this and this is what you made. And then somebody that picked 1 to 200, you open the position of one lot, which requires an initial deposit of this. That means that you just need, see, you can choose higher lots leverage when you have small amount of deposit. The concept of this is that so that you can also trade. Those with big money choose lower leverage. They don't need big leverage. They already have the money. But when you have small amount of money, you choose a big leverage. Now, this is in guise by the broker to encourage you to trade, knowing fully that this leverage you have taken is self-destruction if you don't know how to apply it. So let's say you pick a direction that euro is going to depreciate against the dollar. So you were right that dollar is going to fall in value. And then in the process of falling in value, it fell by 692 pips. By that 692 pips, you made a profit. What he's saying is that you are 692 times 1 times 200. That means that you have made $138,400. Now, the possibility of people achieving this is very narrow. It's 1 in 100. Don't look at this and say, so I can make $138,000 in one trade. The trade that you can actually make this kind of profit is in gold. Those that are in gold will tell you that the way you see the amount of profit you are targeting. So compare $690 to this amount of money. In fact, look at this, compare the difference. What's the difference? That means that with this, in less than 692 pips, that is what you are targeting profit. What is saying that if you check the reverse, in case you were not right, just as little as maybe 20 or 30 pips, in fact, as 27 pips, this whole money has vanished. You make profit because the market went by 692 pips. Let's say the market went against you, you were not right. All you need to take you out here, the way they calculate the profit here, that's how they are going to calculate the loss. And it won't even be this by this number of pips. The system is so organized in such a way that it knows the margin that will take you out. There's a margin for this. When that margin reaches, your money is gone. It won't be up to 692 pips. Maybe 27 pips or even 20 pips, your money has gone. The same way with this one by maybe less than 10 pips, the money is gone. Why? Because you choose a very big leverage and with a big lot size. You choose a lot size whereby each pip is equivalent to $10. Instead of you to be looking at this or this. For $2,000, you can look at this. For $600 and something, you should be looking at this. So that even if you can choose high number of pips, many pips before it takes you out. At least before it gets to where you are, the market has reversed. What influences exchange? What influences exchange rate? We are supposed to stop in the next 1 minute, but I started late, and I know some of us will start in another class by 9. But please, you just give me a few minutes because I just few pages out. I need to cover this today because tomorrow we just have short time to cover so much. So please, you just give me a few minutes to cover these basics. And let me just cover these basics today because the way internet has gone, it has really affected my plan. What influences exchange rates? Central banks, state economics, politics. These are the things that exchange it, that affects it. How does central banks affect forex? Financial circulation. What does it mean, financial circulation? Creating when they are minting new money. It affects the currency because if we are minting more money, the currency must depreciate. It's called quantitative easing. Interest rates. When you increase interest rates, that means you have increased the cost of borrowing. People will deposit money in the bank because they are going to earn more interest. So that way is to control inflation. Monetary reserve funds, when they're actually trying to mop up money, that's why they increase the interest rate. When they bring down the interest rate, it discourages people from keeping money in the banks, meaning that they are not going to earn more money in their savings account. So why should they keep the money in the banks? They look for other assets that will give them good interest. Then state economics, GDP, inflation, debt, sales amount, interest. Who is that person? Please, if you must talk, can you just I keep following. Please mute yourself. So GDP, inflation, debt, sales amount, interest from investors. These things, they are state economics. GDP, all this news comes out. And there are days this news comes out. So, and that's the way you position to trade the news or you avoid the news because it affects the market fluctuation. Stability of government when there are crises or there are political unrest, when there are riots, it affects currency. Public statements, change of officials, just like Trump wants to sack the reserve chair, that affects the market. People, whenever he wants to sack, we're demanding that he should cut interest rate. And that particular reserve bank is independent, and Trump is trying to step in, bringing politics in that direction. So it affects the confidence of investors in that direction. So how do euro exchange rate dropped? Now, just as I was talking about this new central bank, look at how it affects it. This is an example how euro exchange rate dropped. Give an example with euro USD. Whenever you're picking a currency, you look at the country. When you're talking about euro, you look about euro. When you're talking about USD, as long as there is euro and USD, so you look at these two countries, America and euro. When you're looking about pounds and dollar, you look at London, England and United States dollars. We're looking about Japanese yen and dollar. Most of them are paired with dollar because dollar is seen as a reserve currency. Most countries reserve their currency, have a reserve, and they keep the reserve in dollar. So most of them are paired with dollar. So look at an example of news that can affect the market. The Prime Minister of Greece announces referendum. The referendum is looking at, should we split? Should we stay together? Should we change our constitution? Or should we give up this particular land to Turkey or to this group of people? These are referendum. They can say, we need to agree, people should vote. Should we go this way or go that way? That's referendum. Just that news, look at the way the market crashed because Greece is in euro. And just that news, look at the way euro fell in value. And then the ECB, that's the European Central Bank, announces a new president. The market went up. It boosts confidence in the market. So that confidence, it moves up. And times the market will going to move on, waiting for a news. Now, the market is not always a straight line. You can see it's a zigzag. Then another news came out. This name is difficult for me to pronounce. Berlusconi resigns. And that's European again. Boom, the market dropped. Then central banks agreed to stimulate liquidity of financial transaction, to stimulate, when you put money into the economy, to stimulate economic activities. That boosts a bit of confidence, but the market could not boost the market very well because this vaccination, this referendum has really dealt to the market. So long-term holders understand that the market is going to come down. They follow fundamental news and they will just, in this point, instead of buying euro from this point, they decide to take the position of dollar, meaning that euro will lose value. So the moment one, I told us from the beginning, if one is losing value, the other one is getting stronger. So if euro is losing value, it means that dollar is getting strong. What actually you are doing is you are actually taking position with dollar. And the position of dollar is to enter sell. And that is what has been happening, coming down. Our coordinator here is an expert in fundamental analysis. What I'm teaching us here is called fundamental analysis, where you understand that this kind of scenario happens and how far the market can come. Then we on the chart knows how to position ourselves to take this little up like this, and then know this little down, and then little up, and that is what I'll be teaching us. And from this point, the kind of news that will make you drop fundamentally is when you follow the news all the way to this point. Well, now our own is to gauge our position ourselves. When the news come out, we use technical analysis chart and follow the market and follow the market and follow the market. Here, look at another news here. It says the EU cannot agree upon change in the treaty. There are confusions. That alone, look at the way the market crashed. So what does that mean? It tells you that fundamental analysis, this is what affects. You find out that what has been moving the market down is all about news, story, fights here, interest rate here. This one say that one, this one say this one. It's affecting the market, international market. So how do we reach chart? I'm almost coming to an end. What is remaining is not much. How do we reach chart? Because just be patient with me because I want us to conclude this part today, so that tomorrow we're going to go into the serious business of why we're here. Because let me be honest with you, Forex is a long-term skill acquisition. You keep on learning. And so I'm trying my best to simplify it. And that's why I'm emphasizing, reiterating certain key things you should take note of. Leverage, I spoke about leverage. I spent so much time talking about leverage. I spoke so much time talking about lot size. Depending on the amount of money you deposit, you select the right lot size, no matter how good your strategy. Now, how do we read graphs? The news trading is called fundamental analysis, where based on this news, you take a position to sell. So you must understand how to interpret the news to take this position. If you don't know how to understand the news, instead of entering a position with dollar, because euro, they are fighting, there are crises, there are confusion. So investors don't have confidence in euro. Instead of acquiring euro, they begin to buy dollar. So in buying dollar, the high demand for dollar is increasing. This thing you are saying is dropping, is euro that is dropping. As euro is dropping, it means that dollar is getting strength. At this end of the chart here, it shows that dollar is strong. At this point here, it shows that euro is strong. So if euro is falling, it means that dollar is gaining. Dollar is gaining. Dollar is gaining. That is what it means. So you position yourself fundamentally by understanding the news. Then technically, you position yourself. And what does it mean technically to position yourself? That is where reading graphs come in. Based on those news that are coming out, this person has resigned, cut interest rate, the gross domestic product, GDP is out, the inflation, CPI, consumer price index. These are consumer price index is called the CPI that gauges the inflation, the buying power of citizens, of the people, of the citizens. So all these things affect currency. So the central banks monitor all those things to actually know whether to increase interest rate or to reduce interest rate. And this can affect the value of the currency. And you position yourself, you want to buy a currency that is strong. You discard the one that is weak, you buy the one that is strong. And then you look for the one that is, you buy the one that is weak, you sell the one that is strong. So you understand these things very well. You buy when it is weak, you sell when it is strong. You buy when it is weak, you sell when it is strong. So the market can be analyzed in several time frames. This is how you read charts. You read chart according to time. That is price and time. The two things we use in analyzing the market is with time. We begin to look at time. If within 1 minute, what is the price saying? In 5 minutes, what is the price saying? So we have time frames running from 1 second all the way to yearly time frame. I think the MT4 has removed yearly. Formerly used to have yearly candle, but now they have reduced the candle to just monthly. So you have a candle that shows you transaction that happen for the whole month. So some of us will be asking, what do you mean by candle? We explain to you how we read price. Is what we call the Japanese candle. The Japanese people were using candle then in their transaction of rice. That was what they were using to gauge and to gauge the trend and the price value of their commodities then. And then it was borrowed into financial market. Just as I told us, I'm not going to the theory of that. There are materials to read the origin of Japanese candle. That is the term it is used. So there are many different kind of graphs. There are line graphs, there are bar charts, and there are candlesticks. We use candlesticks. So I'll be explaining that when we get to the platform where we trade. I'm just giving us the theory. Today I'm just giving us the theory, the foundation of trading. So let us look at daily. Just a moment, please. Let us look at a daily graph. Now, each graph will begin to show us the trading platform where we trade currencies. You find out that it's time. The time is horizontal. The price is vertical. But most time, the time is not in the top here. The time is below. So you see time with dates. Now, most times, is dates you find below here, right? You find the price here. The time frame is something that you can choose the time, right? You can choose the time. Most time you can choose to see date and time together, but the current platform now have decided to separate the time frame where you can choose the time frame, and the whole of the data you see here will be based on each candle showing the time frame. We'll understand that when we get to the platform. So I'm just giving us a graphical illustration of how the trading platform looks like. You select the time, and then everything here will be giving you analysis that is happening each 1 minute, what happens every minute. If you choose 1 hour, it will tell you candlesticks that are happening every. So it can be a combination of maybe 24 hours from this point to this point. But each candle, each price that happened within an hour. Those of us that have background will understand what I'm trying to say. So for this multiple time frame analysis, when you are looking at lower time frame and higher time frame, and you see that the chart are looking different. Somebody actually asked me that question today. Now she sees the charts coming down in lower time frame, but when she goes to higher time frame, the chart is going up. Yes. At times, when you're looking at from this point to this point, is the movement from this point to this point is pointing downward. It's actually what you're seeing here completely. And it's possible that this time frame you have chosen is a longer time frame, maybe 4 hours. And that 4 hours telling you that the trend is upward. But when you look at the lower time frame, maybe 15 minutes or 5 minutes, but it's looking coming down. This whole thing you're seeing here can just be a section, just this section, or this section, or this section. So you always look at the overall trend in a higher time frame to see the trend. Trend means that is euro going up? Yes, euro is going up. Euro is going up. So you begin to look at euro is going up actually. Euro is going up. So that means you trade in a direction of euro. You begin to look for opportunities to buy here. You buy here. You buy here. Now, if you are entering sell, that means that you are entering from here. At this point, euro is losing value, but euro got value from this point all the way to this point. Euro lose value from this point to this point and gain value from this point to this point. That's what this chart is all about. It's a zigzag going up, down, up, down, up. So each time, if you are taking euro USD, anytime you are seeing something like this, shows that euro is gaining. When it comes down like this, it's telling you that euro lost value. And when it's losing value, it means that dollar is gaining value. Then when it goes up like this, it shows that euro is gaining value. When it comes down, it tells you that euro has lost value to this point. So, but we look at the overall trend in higher time frame. The higher time frame can be from 1 hour, 4 hours, daily, and weekly and monthly. So most times we start our analysis from a higher time frame, and then why do we use lower time frame? We just use lower time frame to enter early. If we understand that this market is going up, coming down, going up, now there are strategies where we know when and where to enter. When price and time align, there's an alignment of time and price. At a particular time and a particular price, we enter the market. When we already know that the market is going up, so we position ourselves. There are people when they already know that the higher time frame is upward, they will never enter sell. They'll only be looking for buy opportunity. When the market comes down, they call it retracement. When it retraces, they look for opportunities to buy at a particular time. Goes up. Some of us might be hearing about time. That is time to trade currency. We'll talk about that. There are a lot to learn. You cannot afford to miss this class. A lot to learn. And then you look at those. There are people that can do buy and sell from all this movement. But there are people that say, no, me, it's only buy and buy. There are people that they're only selling, they're only selling, they're only selling, which is very risky. The person that is buying makes money than the person that is selling. Because if you choose to sell and you come and choose sell from this point, you're thinking that the market will come down. The market goes up, you're losing. That's when we talk about that pip and your lot size. Now, trading strategy example one, going short on the euro. Going short means that we are selling. Going short is to come down. Going long is to go up. So whenever you hear this terminology short, we hear the word short, S-H-O-R-T. It tells you that the market is coming down. That's what short means. So when you say short on euro, it means that sell euro. When you say long euro, it's telling you to buy euro. So short euro can only happen from the peak. Long euro can only start from the bottom. Whenever you hear short, I can tell you short. You can short here. If you short from here, it's possible euro will still go down. But this place is low. From this point, we should be thinking about long euro. What it means that you are taking a buy position from this point. When it says short euro, that means that you are taking a sell position from this point. That's what it means. And then you expect the euro to fall against the US dollar. So this person enter at this price. You open your trade and the broker charge his spread. Remember, I told us what spread is. His own little charge for allowing you to step into the market. the difference in the quote between the buy and the sell. So you decided to want to long short euro, meaning that if you are shorting euro, you are saying euro is losing value, dollar is gaining. So you enter from this position and you can see you're making profit because you are predicting that euro is going to fall. And look at how euro is falling. Look at how euro. So maybe euro came down to this point. So the moment you calculate from this open to this close, maybe it has given you 50 pips, and then you use a lot size of 0.1. That means that you have made $50. If you have a lot size of 110, 1 to 10, that means that if it's $50, you have made $500. And so I advise people, don't choose a big lot size if you have a small account. If you have $20, 50 account, $50, what's a business of standard lot size? You shouldn't even be thinking about mini lot size. You're thinking about micro lot size, 0.01, trading cents. 10 cents is $1. And build your account, scale your account. That's called money management. You are doing business. All right. So, in conclusion, I told us I'm not going to take us. This is just intro. I needed to establish this because I trade. My trading is basically skill. Longevity in this business is what will make you profitable. Not to just jump out and gamble. I must hit it big. I'm seeing forex traders are buying Jeep, buying cars, buying houses. Ask them how much are they trading with, how long they have been in the business. You find that some of them are trading with $50,000, $20,000, $10,000. Most of them are trading with nothing less than $100,000. So they can afford to take not even 10 lot size. You can take 20 lot size. That's how they trade. I've seen people taking 70 lot size. That means for each pip, they're making $70, not even $10. So if the market goes by 100 pips, imagine how much they have made. So these are some of the advice I'm giving here. Start gradually. Don't open many positions. You can open many positions. That means that you can open 0.01 10 times, 20 times, 5 times. Why are you doing that? Don't open many positions at the same time. I will show us practically what I mean by this. It's better to choose fewer positions, but weigh each of them carefully. Stop loss order. Stop loss is the risk you are giving to the market. In case this market goes against me, I'm starting my trading with $100. I am not risking more than $10, but I want to make $20. I'm not risking more than $5. I am not supposed to risk more than 3%. In fact, in most cases, don't risk more than 1%. So if you have $100 and I'm asking you not to risk more than 1%, that means I'm saying not risk more than $1. So if you're not going to risk more than $1, what are you supposed to trade? You cannot go trading on a mini lot size, which is one lot size to $1. You're talking about micro lot size. That means that each pip movement is giving you 10 cents, 10 cents. So you are risking 10 pips. 10 pips, if you lose 10 pips, you have lost $1. You have lost 1% of your account. So you enter into a very good position whereby you know that the market will not go 10 pips against you. So that when the market goes 20 pips in your favor, you have made $2. You have made 2% of your $100. That's $2. So calculate $2 over 20 days. You have made 40%. That means you have made $40. Your account balance now is $140. You can now increase to 0.02. That's how you trade. Because you learn as you are trading. You learn as you are progressing. As you are losing, you are gaining. As you are losing, you are gaining, you are learning. That way you scale your account. That is a stop loss order. Very, very important. Rule 1/6, especially advise against reaching more than 1/6 of your free capital when you are completely confident. What they're saying is that don't risk more than 1/6 of your account. Right? But me, I tell you, don't risk more than 1% of your account. If you are starting with $20, 1% of your account is 20 cents. If you are risking, but because it's too small, they can say, okay, let me make it 3%. 3% of your $20, you calculate it. 3% of your $100 is $3. 5% of your $100 is $5. It's fair. It's even better. You can say I'm risking 10%. So, and that's the way I teach us last time in my synthetic class, how to organize your risk management. If you have $100, you can say I'm risking 10%. I'm dividing my $100 into 10. And for each trade, I'm risking $10. So I'm going to take 10 trades. If I lose the 10 trade, I've lost my money. But there is no way you should trade and lose $10. That means that you don't know what you're doing, you're gambling. But if you know you have a plan, you have a strategy you stick to mechanically, there is no way you lose out trade five trades. No, we play some trades today. We placed 4 trades in our synthetic. We lost out of 4 trades. We lost 1. We gained 3. Out of 4 trades, we are in profit. And each of the trade, if you are planning to, you are targeted to make twice whatever you are risking. For example, you are risking $10. You are targeting $20. You're making profit. So if you place 3 trades and you lose 1 and you win 2, you have made $40. You have lost $10. That is how you should calculate this whole thing. In case you don't want to think about losing 1% or 2% or 3%, you can say, okay, I have $1,000. I'm risking 10% per trade or 5% per trade. So if you have $1,000, you are losing 5% per trade. That means that you are risking $50 and you have 20 trades to place. There's no way you will lose serially 20 trades. It's not right. It shows that maybe you have not trained or something is wrong, or you are just gambling in the market. Stick to the plan. That's what I'm trying to say. When you stick to the plan, you have a plan and a system of risk. You stick to it. Now, different time frames are used for analysis. I've spoken about time frames earlier. Don't stop the profit. Now, what it's trying to say is that you shouldn't stop your transaction too soon. Well, we implement this in our synthetic because we trade based on goal. If my goal is to make 2% daily, I make sure that I move my stop loss to protect my 2% profit. The moment I'm in profit, I move my stop loss from negative zone to the positive zone to protect it, so that if the market is coming against me, it can take me out. I have achieved my goal for the day. Because at times you can set the take profit and the market will not touch it and come back and then go into negative. It happens most times. So I don't always agree with this, allow the profits to run, except when you're choosing a conservative take profit. You can allow it to run maybe 1 to 2. Most times it hits, allow you to just make the profit. It's still not good to come out too early, but most times don't just allow your profit, the market, to take back your profit. Protect your profit by moving your stop loss from the negative zone to the positive zone. And I'll be explaining to us how to break even as we progress. Not today, maybe tomorrow or next. We still have some days to learn. There are so much to learn, and that's why I'm saying I'm rushing this. The recording will be available so that you can take time and maybe very fast, because the internet really affected me. I needed to cover these fundamentals today because we can't spend the whole week talking about this. Don't play against the trend. What I was explaining us earlier, the trend is always defined by the high time frame. So you always look at the high time frame. And the high time frame can start from 1 hour, 4 hours, all the way up to monthly. Just know the direction of the market, and based on that, you go to lower time frame, choose until the lower time frame aligns with the high time frame. You have no business trading that particular asset. That is how we trade. Don't play against the trend. If in doubt, follow the leader. That is where mentorship comes in. That is why we are here. We have a platform where people can share their charts. You can be hearing, people have been sending messages while we're having in this class, asking questions. I review their chart. You go in, and they're making money. That's where mentorship comes in. Trends have momentum. Also, you understand the momentum of the market. You understand the trend. And then when you are wrong, you understand that you are wrong. Don't hold an unsuccessful position went for a long time. Experience shows that it is best to close them early and move on to others. When you have entered and just understand that I'm in the wrong position, cut your loss, allow your profits to run. Your profit to run in the sense that I just lost, you move your stop loss from the negative zone to the positive zone and allow the market to keep on moving. Allow the market to keep on moving. You will make more. You will make more. So, thanks for your time.